Got Ajay Manglunia, who has logged in and who's joined us on the phone line, I believe, Managing Director and Head Fixed Income at Incred Capital. Ajay, just trying to understand the reaction in the bond markets. I may have read it wrong in terms of the increase in the bond yield. So can you clarify which, so there is an increase in the bond yield. So what are you reading in terms of the immediate reaction, Ajay, and how do you explain it?
So market was kind of expecting a token rate cut, which was delivered in the today's MPC meeting outcome. 25 basis point rate cut is something largely was expecting by the market, and it's after a very long time, 5 years later, there is a rate cut in Indian environment. What market was disappointed was some answer to the liquidity. Market was expecting that there could be some kind of a delivery on the liquidity front, which was kind of kept silent, and we have seen that RBI has kind of been doing enough in terms of providing liquidity. Market might be expecting a longer durable liquidity, since we see a lot of liquidity deficit in the market, and that's what is kind of disappointed in the yields in the government securities has gone up by 4 to 5 basis points. It's a knee-jerk reaction, which we can say, and over a period of time, we will see the moderation in the yields.
I just want to clarify, because I'm looking perhaps at the what is not the benchmark, what we have on the screen. What is the coupon on the benchmark right now, Ajay? Because we don't look at this very often. The 10-year benchmark, you're looking at 6.79?
6.79 is the new benchmark right now. Earlier it was 7.10.
Yeah.
So both are traded, but I think more volume is in the 6.69.
6.79. And do you anticipate that this will be something that eases over the course of the next few weeks as liquidity conditions improve?
Yeah, definitely. As we see the market in this security was trading in the range of 6.65 or around 2-3 basis points up and down, and today with the knee-jerk reaction with kind of no mention about the liquidity measures in the policy has disappointed a few traders, and they kind of book profit. It may kind of be somewhere about say 660 to 670 range for some time before it settles down at its own levels. I think 665, 663 is the level where we could see this being traded. February is the month where probably there is no major government borrowings, and as we enter into the next financial year, the borrowing will recommence from the next financial year in April onwards. So we could see some rally in this paper going forward.
Last point, Ajay, and a quick one. Right now, we've got a rate cut as was anticipated, but as you've pointed out, the street is reacting to liquidity. The base case assumption, as I understand it, is for another rate cut sometime this year. And would you say that once the liquidity scenario eases out, you could see a move down to the in the 10-year bonds, in the long-term bond yields? And when do you see that playing out?
Bond yields, as we have been talking about, is more of a stable. The immediate impact of the rate cut will be on the shorter tenor papers like CP, CDs, money market instruments will immediately have a transition for this rate cut. The next rate cut probably people might be expecting in the April, which is the next policy time, and by then we will see the new financial year borrowing will also commence. So we don't see huge rally in the 10-year. The rates might be stable. The more comforting factor with the market is likely to be the stability. Stability in terms of liquidity, stability in terms of rate trajectory, stability in terms of currency, and all of these are basically points to watch out.
Fantastic. Thanks so much, Ajay, for joining us, for giving us that quick view. Just a small clarification. These are not bonds that you look at on a daily basis, as a result of which there would have been a little bit of a confusion. What you see on your screen, or you saw on your screen, was actually a 7.1% coupon, the earlier benchmark. Right now it is 6.79. That's where most of the trades are taking place. And the current yield on that paper is at 6.69, and it has moved up very sharply. You can call it sharply because it is a substantial move. 3 and 4 basis points in a day is actually pretty sharp, but it is likely to stay range bound is what Ajay has just pointed out.